All right, everybody, welcome to Quick Takes. Look, the Fed is down in Jackson Hole this week. That's going to be what everybody's focused on, but guess what? Even though the Federal Reserve is the number one focus point for me on whether or not we are still in a full-blown bear market or it's time to be in a bull market and everything is going to be off to the races to the upside, even though the Fed is the number one thing that I'm watching, that we're not going to get anything out of Jackson Hole. So just whatever happens this week, just ignore it for the most part. It's more volatility in the market. It is not going to ultimately impact whether or not this is a bull market, bear market, etc. This is Jackson Hole. They're going to talk it up. They're going to try to move the markets a little bit, but at the end of the day, you can ignore whatever happens. September, the Fed meeting in September, that'll be what you want to watch. So today I've got two charts that I wanted to throw up for you and take a look at why I've been so bearish in this market. I promised you last week that we would take a moment to step back and take a look at what's going on in this market and why I've been tilted so far to looking for stocks to go to the downside. I mean, I've been talking about it for weeks now, how this market and how I think it lines up with the dot-com bubble. So before we get into all this, though, look, like and subscribe to the channel, scroll below, leave me a comment. Let me know if you think this is like the dot-com bubble, or if you think it's going to be like a global financial crisis and there's going to be a black swan event that we don't even see coming. Leave me your comments below. Let me know what stocks you want me to feature too. I'm going to do more bank it or tank it's here in the coming weeks. I just wanted to take a moment today, do a quick takes on this broad market outlook and kind of what's going on. And follow me on Twitter at ChatShootGuru. I tweet all throughout the week, so you can follow me on there, leave me comments. Let me know what you think about the markets, about stocks, whatever's on your mind. Post it to Twitter, and I'll be sure to get back to you. So we got two charts that we're going to take a look at today. We got the ARK Innovation ETF here on top, the ARKK. And then on the bottom, we have the Invesco QQQ Trust Index. This is an ETF for the NASDAQ 100, the tech-heavy NASDAQ. Now, these are not the same time frames. So I just wanted to point that out, not to throw you in a loop or anything. These are on two different time frames, and I don't usually do this. It's kind of weird. I always think it's goofy when people do stuff like this, and you might feel the same way. But for today, it's really getting the point across of, well, A, what a full-blown bear market is supposed to look like, supposed to feel like, that sort of thing, and B, just the similarities between this ARK Innovation ETF today and the dot-com bubble. I mean, it was a big deal. It's going to be talked about for generations to come. I think what we're going through today is another one of those big deal moments that's going to be talked about for generations. I don't know what they'll call it yet, but this is going to be a big deal. There's just a lot going on, and we're just going to focus on one thing today, and that's the growth bubble that popped. ARK Innovation ETF, whether you like it or not, was in a growth bubble. They had the crypto stocks, innovative stocks, the electric energy companies that had no money yet, but just people were pouring in investments and cash into these companies and just betting on growth and looking for these things to shoot to the moon. And they did there for a while. They were on a massive run higher, and that's what precedes all these tops is a massive run up, and then we get to the top. Boom. 76% drop from the peak to the bottom here roughly on a pullback that lasted what? I mean, this is just over a year and a half from top to the bottom, less than a year and a half. So that's something to keep in mind. That's a short-term bear market if that is the ultimate bottom, and we continue to move higher here. But just think about everything that played out. I mean, we had the crypto growth that was going on in Bitcoin, and I know that became a big deal because my parents got sucked into it. They were, scammed out of some money on, these penny stock crypto type things that are not even really penny stocks. They trade for, fractions of a penny, and you're supposed to throw $100 on them, and they go up like Bitcoin does. Well, for a little while back in 2020, this was working, and then all of a sudden it stopped. They all turned out to be scams. It was just a big scam pot of where everybody, all the money that went in there, just ended up being stolen away. I mean, that was a massive thing that was going on. I was following it. I know a lot about what was happening. I know that there's millions and millions that have just got scammed right out of people's hands. I think that's similar to the dot-com bubble. Because back then you think there was companies, and that's the argument between the difference of back then and today. The ARK Innovation ETF is full of real companies with real businesses that you can see in real life. True. Those real businesses can still go bankrupt. And we're not out of this yet. So I think that we will see many businesses still go into bankruptcy before this is all said and done. But back during the dot-com bubble, I mean, you had Joe Schmo create a website, put a .com on it, and make a public company because people were just throwing money around. So I get that there's there's differences. I'm not saying that this is an exact alike scenario. I'm just saying that the similarities here are more than enough, just to throw out the window. Like they're worth taking another look at here, because this is the dot-com bubble over what? We're going from March 2000 to the bottom here, April 2001. So basically a year. The whole chart's a little over a year, but basically a year, down 70%. And when you just look at the nature of these declines, and the reason why I don't like overlapping charts like this is because you can line up a lot of different things, and over any given time period, they're going to have some similarities, especially on big crashes and big run-ups. They're going to look similar to other run-ups. But this one is eerily similar. I mean, look, you had the initial drop on both of these, then kind of a flat line there for a few months, and then you had the quick drop. This is the bigger move lower that really stung. This is where you're actually losing money and it's realistic and you feel it. This move lower here, I mean, this is where everybody's buying though, right? This is where it's still like, it's not clicking that this thing is going to go down to 75% to the bottom. So you're buying all the way down here, and the same thing here. It's just a quick drop, couple little rallies in between, but ultimately down to the bottom. And then off the low, we get a little bounce. That's where we are today. Off these lows, we're getting a little bounce, starting to come back down. So I just thought that lining up these two charts, time frames are very similar, and just the moves like that are just really, really close. And now for ARK Innovation ETF, though, we zoom out. We're at the end of the line. This is up to today's date. So we don't have any more price action. We're going to see how this plays out. And I don't think that any two bear markets are going to be exactly alike. But we're already not comparing like a major ETF to another one. We're comparing the ARK Innovation ETF today to what the dot-com bubble was back in the early 2000s. A new, popular hot index / ETF that people were just racing for and excited for and could do no wrong and ran up, and then the bubble popped, and then everything came rushing back down. But look, you look on this dot-com bubble chart about where we are, after this year period, 70% drop. What happens next? Are we, going to shoot higher and off to the races and back into the bull market? Well, I think most of you know how this plays out. No, it keeps going lower. It's down to ultimately about an 80% pullback there from top to bottom in almost a 3-year period. I mean, this was March 2000. The bottom was October 11th, 2002. So we're 2.5 years out before we hit the ultimate bottom. And then the rally, people, the rally was not that. I mean, it was strong. It was strong if you caught the bottom. It was not strong if you bought on the way down and we're hoping that these stocks were going to come back, which I know is where a lot of people are in this area up here in the ARK Innovation ETF. You bought all these stocks, companies that could do no wrong, just very strong growth companies, and said, you know what, they're going to be higher one day. They may be, but if the dot-com bubble showed us anything, that these growth stocks, once they fall out of favor and they burn investors like they're setting up to do this time. I mean, it looks a lot like it, even now, down 76%. I mean, a lot of people were burned. It takes a while for them to come back. I mean, this shows. This index was full of companies like Apple, Microsoft, Google. I mean, this is where they lived. And look at that ETF. I mean, this is years. I mean, it took decades because, look, then 2008 hit. Another crisis hit before this thing got back to the highs. So for the S&P 500, for the Dow, because I wanted to leave off on the positive note, they didn't fall that much. S&P 500 down 50%, much better than 80% for the NASDAQ 100. So that's great. The Dow down just 37%. So again, not as big of a drawdown. These are larger companies, more stable stocks, but not as big of a drawdown. And then on the upside, coming out of this, took the Dow, no time to get back up to those highs, and then eventually pushed through that within a decade. The S&P 500, very similar. Beaten down, but then we get a nice strong rally out of that. Before the '08 crisis, we were back to the highs. So that is a stark contrast to what happened to growth stocks from what we're seeing from other stocks in the world. And I think that's the positive note. That's how we spin all this to a positive from where we are going now. If you saw the ARK Innovation ETF chart and the dot-com bubble, and just, you just get down on yourself and you think that this is the start of something real bad. I mean, that's not what I want you to feel. I want you to feel excited, because I think that even though this ARK Innovation ETF is going to struggle, and even though I think that this bear market is going to take hold again and we're going to go lower, the bigger picture here is that these large cap stocks, which today, I mean, we're comparing the ARK Innovation ETF, which is an innovation ETF. That's kind of what it's supposed to be, to a major index like the NASDAQ 100. So we are like a few derivatives behind here to compare it to the S&P 500 and the Dow Jones today. I don't think those can have to go through as bad of a pullback if all we're talking about is a growth bubble popping. The problem is we're not just talking about a growth bubble popping. The growth bubble has already popped. The big issues are already out there. We have inflation. Inflation, by the way, is not that bad for the stock market by itself. What's bad right now is the Federal Reserve. Now, as I mentioned at the beginning of this video, the Federal Reserve is going to be the top focus point for me. We're just not going to get much out of them this week. September meeting, all eyes on the Fed. So I'll be talking a lot about the Fed over the next couple of weeks. No need to get into it today. So that's all I have for today. I wanted you to stay optimistic in the markets, in what's going on, and that even if this is kind of the worst case scenario, another bear market, doesn't have to get that bad for the major indexes that are out there in your large cap holdings. Just the small stocks that are already beaten up can still take a tumble. So you want to buckle up, strap in, be ready to ride out this volatility, because I don't think it's over just yet. So that's all for today. Like and subscribe to my video. Leave me a comment and let me know what you think. Until next time, I'm Chad Schuber.